Welcome back to the Crypto Intellect, where we break down the biggest crypto stories shaping the future of money. Today's headline sounds unbelievable at first glance, but the institutional signals behind it are very real. Wall Street is moving, the SEC just opened another major door for crypto exposure, and XRP is sitting right in the middle of the conversation. If you've been wondering whether the institutional thesis around XRP is finally becoming visible in public, this is the video you've been waiting for. Let's start with the biggest development. Rowe Price, one of the most respected asset managers in the United States, just received SEC approval for an actively managed crypto ETF. That alone is major news. But the part that has the XRP community paying attention is this. XRP was included on the eligible assets list. We're not talking about a random startup fund here. Rowe Price manages retirement money, pension capital, and institutional wealth built over decades. When a firm like that steps into crypto, it sends a signal far beyond retail speculation. Now here's where it gets interesting. The approved product is actively managed, not just a passive spot ETF that blindly tracks prices. That means professional portfolio managers at Rowe Price can actively decide which crypto assets deserve larger allocations and how to adjust exposure over time. In the reported index context surrounding the approval, XRP carried a weighting of 11.42%. Pause there for a second. That is a serious number. XRP's market cap is smaller than Ethereum's, yet its weighting came in at more than half of Ethereum's allocation and ahead of several other major altcoins. That matters because institutional portfolio construction is not based on hype. It's based on perceived utility, liquidity, infrastructure, and long-term relevance. A legacy Wall Street firm did not accidentally give XRP that level of importance. It suggests that institutional analysts increasingly view XRP as infrastructure, not just another speculative token. And that fits with what we've been seeing quietly develop for years in the background of the crypto market. Before we go further, a quick reminder. This is not financial advice. This video is for educational and informational purposes only. Always do your own research before making investment decisions. And if you think more investors should understand what institutions are doing around XRP right now, hit that like button because it genuinely helps this information reach more people. Here's the second layer of the story. Morgan Stanley, the largest wealth management operation in the United States, has already been building its digital asset framework in plain sight. Their SEC filings disclosed exposure to XRP-related investment products, including shares tied to XRP volatility-focused ETFs and Grayscale's XRP offering. No, the positions are not enormous, but institutions do not file regulated disclosures on assets they have zero interest in understanding. A 13F filing is a legal document. It's part of a broader strategic process. But the bigger signal came from Morgan Stanley's own research. Their analysts formally described Ripple's payment network as a leading alternative to SWIFT for cross-border payments, and they specifically identified XRP as the bridge asset used for real-time settlement. That is not a YouTube talking point. That is institutional research language being read by wealth managers, allocators, and financial professionals across Wall Street. There's a huge difference between crypto influencers talking about XRP utility and a top-tier financial institution putting it in writing. To understand why that matters, you have to understand SWIFT. SWIFT is the decades-old messaging network used by banks around the world to move money internationally. The system works, but it's slow, expensive, and layered with intermediaries. Ripple's model aims to settle transactions in seconds instead of days, with lower costs and greater transparency. Whether someone is bullish or bearish on XRP, that is the core institutional use case being discussed at the highest levels of finance. And this is where today's story starts connecting into one bigger picture. During Ripple's legal battle with the SEC, court discovery revealed something that many casual investors still don't fully grasp. There are roughly 1,700 documented contracts and NDAs between Ripple and financial institutions around the world. These are not internet rumors. Their existence became part of the public legal record. Yet most of those relationships have never been publicly announced. Why? Because banks operate under strict regulatory and compliance frameworks. Right now, many institutions engaging with crypto infrastructure rely on SEC no-action letters or similar regulatory guidance that provides temporary protection from enforcement. The problem is that those protections are not permanent law. They can change with administrations, policy shifts, or regulatory reinterpretation. A bank is not going to publicly announce deep XRP integration across its payment infrastructure if future legal uncertainty could create compliance risk later. That's why so many relationships appear frozen in silence, even while the infrastructure work may already exist behind the scenes. In other words, the missing ingredient is not necessarily technology anymore. It's legislative clarity. Only Congress can provide the kind of permanent legal framework large banks truly want before they go public with major crypto integrations. That is why many analysts believe the market is watching Washington as closely as it's watching price charts. The unlock may be regulatory certainty, not another viral headline. Now let's talk about ETF flows, because this is the part retail investors often miss. While XRP's price has gone through periods of pressure and sideways movement, the amount of XRP held inside regulated investment products has reportedly continued growing. US-based XRP spot vehicles moved from roughly 847 million XRP to over 923 million XRP during a period when retail sentiment was cautious. Globally, XRP products are estimated to hold well over 1.2 billion XRP. That is not retail panic buying. That is regulated capital quietly accumulating exposure through institutional channels. And look at the names involved: Franklin Templeton, Bitwise, Canary Capital, 21 Shares, Grayscale. These are serious financial players building products around XRP exposure. Institutions tend to move slowly, methodically, and before narratives become obvious to the public. By the time retail sees non-stop bullish headlines on CNBC, much of the positioning is often already underway. Another key development that deserves attention is Morgan Stanley's organizational shift. The firm appointed Amy Oldenburg as head of digital asset strategy. She's not a crypto influencer parachuting into finance. She's a veteran executive with decades inside Morgan Stanley, including leadership in emerging markets. Her appointment formalizes digital assets as a long-term strategic initiative across the firm's wealth management, investment management, and self-directed trading businesses. In public comments, Oldenburg highlighted how countries like China, India, and Brazil are rapidly digitizing financial infrastructure. Her broader point was clear: tokenization and blockchain are no longer theoretical future concepts in institutional conversations. They are becoming operational priorities. That aligns perfectly with the direction global finance has been moving, toward programmable assets, tokenized settlement, and real-time financial rails. Now let's be honest and keep this grounded. None of this proves that Morgan Stanley is secretly buying billions of XRP tomorrow morning. There is no public evidence that Morgan Stanley is a direct Ripple client or that XRP sits on its balance sheet in some massive undisclosed position. It's important to separate evidence from speculation. What the evidence does show is that major institutions are building infrastructure, research frameworks, investment products, and strategic teams around digital assets, and XRP consistently appears inside that institutional conversation. For long-term XRP holders, that distinction matters. The bullish thesis was never supposed to be XRP moons overnight because of one tweet. The institutional thesis was always about gradual integration into financial infrastructure, regulatory clarity, and adoption by major players over time. That process is slower than social media wants it to be, but the data points are becoming harder to ignore. Think about the sequence we're seeing. A legacy asset manager gets SEC approval for an actively managed crypto ETF that includes XRP. A top Wall Street firm publicly describes Ripple as a leading Swift alternative using XRP as the bridge asset. Institutional XRP investment products continue attracting capital during weak retail sentiment, and hundreds of documented Ripple banking relationships remain in the background waiting for clearer legislation. These are not isolated events. They are pieces of the same larger institutional puzzle. And maybe the most important quote in this entire discussion came from Amy Oldenburg herself when she described Morgan Stanley's digital asset effort as a decade-long initiative. Not a 2026 trade, not a quick cycle experiment. A 10-year strategic framework from the largest wealth management platform in America. That should tell you how traditional finance views this space. Not as a fad, but as a long-duration transformation of financial infrastructure. So where does that leave XRP? It leaves it in a very unusual position. Bitcoin remains the dominant store of value asset in institutional crypto. Ethereum dominates smart contracts and tokenization narratives. But XRP occupies a niche almost no other crypto does: institutional cross-border settlement infrastructure tied directly to banking conversations. Whether the market fully prices that in yet is another question entirely. At the same time, investors should stay balanced. Regulatory delays can drag on. Legislation can move slowly, institutional adoption can take years longer than crypto Twitter expects, and price action does not always reflect fundamentals in the short term. That's why disciplined investing matters more than emotional hype. But if you step back and look at the macro picture, today's developments reinforce one thing clearly. Wall Street is no longer treating crypto as a fringe experiment. It is building products, teams, research, and infrastructure around it. And XRP is one of the few assets repeatedly appearing inside that institutional architecture. So now the big question becomes this: what happens first? Does Congress finally deliver comprehensive crypto legislation that unlocks broader banking participation? Or does a major Wall Street firm launch a direct XRP-focused product before that happens? That's the debate now, and honestly, either outcome would move the conversation around XRP into an entirely new phase. Drop your answer in the comments. What comes first? Permanent crypto legislation or Wall Street's first major direct XRP product? If this breakdown gave you a clearer picture of what's happening behind the headlines, make sure you like the video and subscribe to the Crypto Intellect so you don't miss the next major XRP update. Stay informed, stay patient, and I'll see you in the next one.